Welcome back to Uncontested Investing. I'm Tim Harrods. Thank you so much for swinging back by. Today, I am with a guy, you can't tell him I said this, that I think is probably the smartest person in the industry, Rick Sharga. Rick, thank you for being here, bud.
Always a pleasure talking to you, Tim.
So I'm going to dive right into your crystal ball. What will mortgage rates be in 12 months? No, I'm just kidding. I'm kidding. No, really.
Take this with a grain of salt because I was one of the people that thought mortgage rates would be back down in the fives this year.
Yeah, me too.
Didn't know the bond market was going to go insane and that the financial industry was going to react to the Fed keeping rates too high, too long, which they've been telling us they were going to do for the last year. So why that was a surprise to the finance people, I don't know. I still think when the Fed says it's done hiking the Fed funds rate, we will start to see mortgage rates come down slowly and gradually. And the key words there are slowly and gradually. And by the way, the reason I believe that is because every time in history when the Federal Reserve has said we're done raising rates, mortgage rates have started to come down. So assuming there's one more rate hike this year, maybe later in the fall, and the Fed then says we're done for now, I think we could see rates back in the high sixes by the end of this year. And we could see them anywhere from the low sixes to the mid fives by about the midpoint of next year. So I'm hedging a little bit just because this cycle has taken a little longer than I'd expected for 2023.
Likewise. And now you see why I think he's so smart. That was a good answer. So for the audience out there that does not know who you are, would you maybe give a little 60-second introduction?
Sure. No, I appreciate that. I run a small consulting company called CJ Patrick Company. We're a market intelligence firm providing industry insights, forecasts, and analysis for companies in real estate and mortgage. I've been in those industries now for about 25 years. First half of my career, I spent marketing technology companies and just kind of fell into real estate with a startup back in 2000 called Realty Track. And I have been in the business via Realty Track and then Carrington Mortgage Holdings and Auction.com and Adam Data, and now kind of threw up my own shingle and I'm doing my own business. But I've been dealing with real estate and mortgage related data now for more than 2 decades, and it's been a fascinating ride.
And so we'll throw this up on the screen and put it in the show notes. But Rick is very active on Twitter and LinkedIn, so make sure you follow him there for constant updates, and you don't have to just Google him every time you want to know what's up, because he does not post much on his blog, but I'm talking to him about that. He's got to fix that. Rick, the first segment is the bottom line up front. Let's face it, a lot of people start listening to podcasts and they don't finish listening to podcasts. So I like to take the first 2 minutes, give the listener kind of the cliff notes of what's going on in the market, what my guest thinks is important for people to pay attention to, maybe things they should avoid, just kind of hit them in the face with as much as you can in 2 minutes. Good to go?
Good to go.
Go.
Well, the good news is I think the likelihood of a housing market crash, at least in terms of pricing, is very, very, very minimal. And that's been a worry that I know a lot of investors have had over the last couple of years. We have this rate lock effect in place. If you're a homeowner with a 3.5% mortgage and you sell your house, you have to buy another one. Even if you buy one at the same price with today's mortgage rates, you're going to double your monthly payment. So we're just not going to see a lot of inventory coming to market. That lack of inventory makes it tough to find properties to buy. Not impossible, but tough. But it's going to keep prices pretty much where they are. I'm actually seeing investors go and buy properties from new home builders right now. And that's a phenomenon I haven't seen too much in the past. Very hard to make those kind of purchases pencil out if you're a fix and flip investor, but not impossible if you're a buy and rent investor. And I would encourage people to kind of think outside of the box in today's economy, today's housing environment, because the prices, the median prices on new homes are actually down 16% from peak a year ago. The median price on existing homes is actually up 3% year over year. That's simply because of supply and demand. The other thing I'm telling both real estate agents and real estate investors is you really need to be focusing on people who need to sell as opposed to people who might want to sell. So you're looking at reverse mortgages where the borrower has passed away. You're looking at divorces. You're looking at places with job losses, or on the positive side, new marriages or new kids. So look for people that need to sell their properties, and there are sources you can find all of that data, and that's where you're going to be able to find the assets you need to buy. And by the way, in a lot of those cases, you'll be buying properties that don't need a ton of work because the current owners have been keeping them up. So there are opportunities out there. I think we're seeing more activity in the rental market than we're seeing in the fix and flip market, certainly for the last few quarters. And if you're a new investor, you really need to be working with somebody who can make sure that you're doing the right math on those fix and flip investments. No faster way to lose everything than to overpay for a property based on what you think you can sell it for, and then to underestimate repair costs. So there's not a lot of margin in today's market, so you really need to be careful.
So interesting, one of the things you said there in the bluff was new investors buying from new home builders.
Mm-hmm.
And it was early August, a company in Dallas-Fort Worth looked up my company, found me on Google, called me, and said, we've got 9 houses in this subdivision that we would be open to an investor offer. I'm like, okay. My guy calls me. He's like, hey, Tim, you may want to call this. Sounds like it's kind of a big deal. I said, yeah, I'll call him because I don't really answer the phone at the investment company anymore. And I call and I was like, well, what's the deal? And the builder's like, well, they've already been discounted off of what we thought they'd be worth. I'm like, okay, well, how's that working out for you? But I look at these 9, and it's in this controlled subdivision. The builder still has control of the HOA. I'm more experienced than some. I'm like, tell you what, so I don't buy like a whole block. Why don't I look at this one, this one, and that one? I picked 4 that were kind of on the outer edges. And I was like, but I need you to write into the declarations for the HOA that renting is allowed. Oh, no. I said, well, look, man, right now you're still in control, and you can do it without a meeting or without a vote. But if you're going to be recruiting investors, this doesn't work as a flip. The same thing. Like, I can't flip this house. And anyway, so a little advice for you guys out there. Number 1, I got him to do that. Number 2, I told him we would not report the sale to MLS, so it doesn't affect their comps. Right. So if we go in and buy a house at 80 cents on the dollar off of already discounted, that's going to affect their comps and their appraisals. But number 3, the third piece of advice that I'm worried a little bit for these new investors is at RCN, we finance ground up construction. Right. And one of the things is always, what will the taxes be?
Right.
Because right now it's taxed as dirt, but there's sticks and bricks there.
Yep.
And that's, I don't think it's a big default issue coming in the DSCR space, but it's definitely an issue because the last 3 years, there's been a lot of people that were originating some 0.9, 0.95, 10 DSCR loans. And Rick, my property taxes on my Texas portfolio went up by like 35% this year. My insurance went up by 20%.
Well, that's what I was just going to say. That's the other area that investors really have to be more sensitive to than they have been in the past. We're seeing insurance rates, premiums double, in some cases triple. And if you're looking at Texas in particular, I don't think the wave has really hit Texas yet. I think the worst is yet to come.
It's starting.
So I do some work for a company called Verisk that does extreme weather data.
Mm-hmm.
And 18 of the 22 metro areas with the most severe hail events this year have been in Texas.
We've had 220 storms this year.
Yep. Yeah, and the damage it causes the insurers to ratchet up premiums. And the other thing that people don't think about, and this is one of those brilliant observations of the obvious, is property values have soared. So if you're insuring a property and the value goes up, guess what else goes up?
The insurance.
Yes.
Well, and then also almost all policies now have to be replacement cost policies.
Yes.
So not only has the value gone up, the cost of labor and materials has gone up. So
you really need to be factoring in things that you might not think about when you're looking at buying that property. A lot of home buyers, a lot of investors will say, okay, what's the price of the home? What are my finance costs? And they forget about all the other stuff. And taxes and insurance are two variables that in both cases have been going up pretty significantly over the last couple of years. So absolutely need to build those into your models. And you make a great point about the ability to rent a property in a new home development because of those HOA rules. Now, I live in California. In my area, renting wasn't even something they wrote into the HOA rules because they didn't think anybody would rent these properties. Now, as it turns out, in my neighborhood, I think we have one or two properties being rented out, and these have been long-term tenants in the properties who moved in because they wanted to be in the school district, but maybe couldn't afford to buy a house in that neighborhood. So it worked out kind of a win-win. But you do have to be really, really careful about buying these properties. They're not gonna pencil out as flips. But if you buy it and then find out you can't rent it, you're in a world of hurt.
Oh yeah, absolutely. Now, one of your most popular sayings, according to Tim Harridge, is in an interview or a webinar or something. One time you said, "We did extensive surveys, and most people prefer to live indoors."
Yes.
And that brings me to my next question. Housing supply, lack of inventory, more people than homes. Where are your thoughts on that right now? And let's just say, how do you feel about household formation, housing supply, and future demand for maybe the next 18 to 24 months?
So we have the largest cohort of young adults between the ages of 25 and 34 in the history of the country. Millions and millions of millennials and Gen Z folks.
Hold on. Emilio, how old are you?
I'm 27.
All right, there we go.
Right on the cusp, right on the end cusp of millennial and the beginning of Gen Z. And it's like my household. I have two adult kids living at home. But there's millions of these people coming to market. The average age of a first-time home buyer last year was 33. But they are now in prime ages for household formation.
Which what is that for the listener?
It's probably between 26 and 34.
No. I mean, what is a household formation?
Oh, you leave mom and dad's and you set up your own household. So that can be a rental property, it can be an owner-occupied property, but it is a new household being formed by either a tenant or an owner-occupant.
So we're not building a house.
No.
We're taking a human being that used to live with someone else, and they're establishing their own household.
Yeah, and that's the way you just phrased that is exactly right, because could have even been, three people sharing an apartment, and two of them have now left to get their own apartment. That's two new households that have been formed.
Okay.
So,
but if two of them were dating and moved into the same house to form a household, that's only one household. Gotcha.
That's right. So, yeah, it's not dependent on number of people; it's number of doors that are being rekeyed.
Rekeyed.
And the research has been saying. I was one of the people who was jumping up and down saying the whole millennial myth about them not wanting to own a home was ridiculous. And if you look at any of the research, the millennials wanted to own homes at the same rate as Gen X did, at the same rate as the boomers did. They just got started later. And keep in mind, a lot of these millennials came out of college during the Great Recession when there were no jobs and they had student debt. And it was
and they were watching their parents get foreclosed on and all their friends' parents.
Exactly right. And so they got their first real job later. They got married later. They had kids later. And because of all that, they became homeowners later. But they became homeowners. And for the last, I think, 12 quarters, except for one, they have been the biggest buyers of homes across the country as a group. The boomers snuck in about a quarter ago, but they came back again. But
some boomers, they just won't go away.
No, they won't. And that's actually part of the problem with the inventory. You're talking about inventory and what it's going to take. Boomers in much larger numbers than prior generations have aged in place. And now, because of all the equity they have, they don't necessarily want to sell because they're going to get killed with capital gains taxes. So they're tapping into the equity they have, and they're fixing up their current home and making it more livable as they age. Now, one of the economists that I talked to said something a little bit maudlin at an event lately. He said, those boomers will eventually leave the home, either vertically or horizontally, but they will eventually leave the home. And that'll bring some inventory back to market.
Right.
And it's funny, Tim, how these things change over time. First, the boomers were all going to leave and downsize. That was going to bring inventory to market. Then that wasn't going to be good because these are all big homes. And who would want a big home? That's not what the next generation would want. And then we had COVID. And now everybody wants a big home because they want that home office. They want the ability to work from home. They might have to homeschool again.
Dining room is important again because you actually have to eat in there.
Yes. So it's funny how these things go through cycles, but we will eventually get boomer inventory back to market, not in a hurry, but eventually. But the real problem is inventory levels right now of existing homes nationally are at a little over a 2-month supply. In a normal balanced market, that'd be about a 6-month supply. So it's because it just doesn't pay for somebody with a 3.5% mortgage to sell that property and buy another one with a 7% mortgage. If you think about the math, if you sell a property and buy another one at exactly the same price, your monthly mortgage payment doubles. And who sells a house and buys another one at the same price? I mean,
Right.
Nobody.
No one.
So this inventory is not going to start coming back to market unless somebody has to sell, until I believe interest rates get down below 5.5%. And then people can start to rationalize, okay, I'm at 4, 5.5 isn't that big a jump. And by the way, I've had another year to build up equity for a down payment. But I think that's what it's going to take. And that's one of the reasons we're seeing more new home sales, relatively speaking. Again, new home median sales prices are down 16% from peak. Existing home sales prices, median sales prices are up 3%. So the builders are negotiating. This scenario you laid out with the builder you were talking to, isn't that unusual? They have a few properties left at the end of a development.
Well, in this case, they have 5 subdivisions going.
Yep.
That they planned and did all the deed restrictions in place based off of 2-year ago math.
Yeah, and that math doesn't exist anymore. But people that would be buying existing homes are actually getting better deals on buying new homes. The builders are coming in with cash. They're paying points to bring down mortgage rates. In some cases, they're handling the financing. They're doing concessions. And this doesn't mean necessarily that a property they built last year has been discounted 16%. In a lot of cases, they're now building smaller homes. They're building homes with less expensive materials to keep price per square foot down. But they're also not building enough to make up that imbalance you were talking about.
Right.
So there's housing start numbers came out. They're down about 12% year over year on the single family side of things. What's interesting there, though, is permits are actually going up pretty significantly.
Really?
So the builders are bullish on the future, but they're very, very cautious about the present. And they're still working through a glut of properties they started building during the pandemic, but couldn't get finished because of supply chain delays and because of labor shortages. So they're working through that inventory before they start breaking ground on new stuff. Where there is going to be inventory available, and this is important, I think, for your investors to keep in mind, is there's a record number of multifamily units in construction today.
I was gonna talk to you about that after the break, and I wanna hold on to that because these new deliveries, both in single family and multifamily, over the next 10 years,
Yep.
could present a 1990s type situation, in my opinion. So stick around. Oh, I got to go to break. Stick around. We'll be right back. At RCN Capital, we know that time is money. With our competitive rates and quick turnaround time, you can receive funding in as little as 10 days. We offer flexible payment plans to relieve the pressure of repayment process. Our team is experienced in making sure that you choose a loan that will suit you best. Get on the phone with the loan officer today by emailing info@rcncapital.com or clicking the link in our bio. Welcome back to Uncontested Investing. I'm Tim Harridge. I'm still here with Rick Sharga. I cut him off before the break. Let's go.
Yep.
I'm going to tell you my opinion, and then you just go on your riff, because I know you know more than me. I look at what happened in Dallas-Fort Worth starting in the late 70s. Massive interest rate rise.
Mm-hmm.
Within the next 10 years, property values doubled. My mom bought a house for $18,000 in 1974. Sold it for like $80,000 in 88. By the time that happened, there was a guy that was in prison here recently still that started, the multifamily boom was so big in DFW, he was pouring slabs from multifamily properties, and he would bring the Californian investors in, put them in a helicopter, tour them around all these awesome developments, sell them on the buildings, take their money, and never build the building. But that's where all the multifamily overages came from, and then we started going through the apartment to condo conversions in DFW. When I look at all the deliveries in these Colliers reports and the multifamily executive reports, and you see a place like Boston, I want to say the number was like 300,000 new it's just, there's a lot of this stuff in the pipe. Is it too much, Rick?
No. And I say that with an asterisk because you just never know. But there could be as many as 1 million apartment units coming online this year. 1 million. And that sounds crazy. And then go back to what we were talking about in terms of single-family residential properties, homes. Depending on whose numbers you believe, we're short anywhere from 2 to 6 million of those. So bringing 1 million apartment units to market when you have tens of millions of households getting ready to be formed, you're going to have some markets that overshoot. And that was the asterisk. Yeah. So nationally, if you could put all the apartments where they were needed, 1 million wouldn't be too many.
Right.
But we know that some markets are still going to be underbuilt and some markets are going to be overbuilt. The important point for your investors right now, the people watching this, is if you're a rental property investor, and in today's market, it's more likely that you are than they're a fix and flip investor. There are going to be people who wanted to buy a house who've been priced out by the combination of really high home prices and really high, relatively speaking, mortgage rates. And they're going to rent for a while. If they wanted to buy a house, they'd probably be more inclined to rent a house than to rent an apartment. So if you can find those properties in for example, in desirable school districts for those families who've now outgrown their apartment and are looking for something bigger, you have at least I think a 2 to 3 year window of opportunity to rent those properties out. The vacancy rates on apartments are extremely low still, and the vacancy rates actually in the single family rental market are very low as well. And we're seeing prices stabilize there. They had been falling. Rental prices have been falling for a while.
Both single and multi?
Mostly on single family. The multi was the price appreciation came down dramatically. But look, we're coming off a period where prices went so high that they kind of had nowhere to go but down. Asking rental prices last year peaked at about 15% increase year over year. This is in a market where the average year over year increase is between 1% and 4%. So 15% was just off the charts. And that's because there was nothing available to rent because of these households being formed. And so I think there's lots of opportunities for rental properties. I also think there will probably be some properties. What I would be looking at is I'd be looking at Airbnb listings. and I would be looking at these
salt on the wound.
Sorry. Look, there's a lot of Airbnb owners who are accidental investors.
Yeah,
they got a
term rental. Yep.
Well, they had a great mortgage rate on their home, tons of equity buildup. They want to move. They don't want to give up the mortgage, so they tap into the equity, buy a new house, decide I'm going to be a real estate tycoon. I'm going to become an Airbnb owner in my old house. And for a lot of them, it's not working out quite as lucratively as they expected it to. So, I mean, all kidding aside, I'd be looking at Airbnb listings where it looks like they're never being rented out, because there are going to be a lot of these owners who just really didn't do the math and will be happy to offload some of these properties.
So wait a second. Are you telling me that AirDNA could become a new prospecting tool?
It could be.
Because it tells you, a place like Rockwall, where Jennifer and I live, it's only 43% occupied on Airbnb right now.
Right.
And the AirDNA data, it's starting to show these nightly rates at $80 a night, whereas there's 130.
And that's exactly the kind of data. So I love data, as you know. That's exactly the kind of data you want to be looking at. If an owner has had to cut their rates in half, they're getting desperate to fill them.
And their occupancy's down by 50%.
So, they're trying to get anything, but it tells you they don't have unlimited funds to keep making the payments on those properties. Some of those are likely to go into foreclosure at some point. But before they go into foreclosure, reach out to those owners and say, hey, I'm interested in inventory. You have some, give me some. And
there you go. Hot take. Prospecting on Airbnb. I'm telling you what, though, too, short-term rentals, a lot of people got into that because it sounded sexy and cool, but it's the hospitality business.
Yeah.
It's hard. And we've got them, and I could show you on my app the idiotic. There have never been so many grown men that don't know how to change an air filter or batteries in a remote, Rick. Like, the day that I ever am sitting at home on Sunday and would reach out to someone saying, I can't make the TV work, heck no.
That's what you need teenagers for.
I'm the guy in the house that everybody comes to and says, hey, the TV won't work, right? Like, I can't imagine having my family somewhere and calling someone, I can't make the TV work.
No, but can you imagine now being the owner of that Airbnb and also not knowing how to make the TV work? And that's a lot of, I mean, a lot of these accidental investors, these, fledgling real estate tycoons who, they read somewhere it was a really good opportunity to get in it. And we're picking on Airbnb, but it's any of the short-term rentals.
Yeah.
But as a professional real estate investor, you can take over that property. And if you want to stay in the hospitality business, great.
You could do a midterm rental.
Do your homework, figure out, do a midterm rental, do corporate housing, temporary corporate housing, or turn it into a traditional rental, or, God forbid, fix and flip the damn thing. I mean, so there's all sorts,
fully furnished,
all sorts of things you can do. Yeah, and again, it's just I'm trying to help people get a little bit more creative finding inventory, because the truth is the builders aren't building fast enough to accommodate supply. Existing homeowners who aren't motivated to sell today are going to be sitting for another year and a half.
Yep.
And by the way, I said 2 months of inventory nationally. There are markets with way less than that. I was doing some work for a client. For some reason, we were looking at Richmond, Virginia. Do you know in Richmond, Virginia, there's less than a month's supply of inventory available for sale?
And that's across all the entire MLS, right?
Yeah.
See,
the entire metro.
I looked at DFW, and we're at or close to 3 months again, whereas for a while there we were under a month. But if you break it up by above or below the median is less than a month.
Yeah.
All the inventory is above the median price.
Yep.
Here.
Well, it's like Lake Wobegon from NPR, where all the kids are above average, which kind of doesn't make sense. But anyway, it's true across the country, and it's Texas is kind of two worlds right now. There's Austin, and there's pretty much everywhere else.
Right.
So if you're up in Austin, you're seeing prices decline. Anyway, we started out by talking a little bit about that. I am still reading and seeing stuff online about the coming housing crash, and it drives me crazy. So for anybody who's listening to Tim and I talk today, you see somebody online selling something based on a housing crash, run as far away and as fast as you can, because they're selling you snake oil. They're selling you what's probably expensive, educational sessions and software that's going to get you in trouble. It's just going to cost you money and not return anything, because there is no housing crash coming.
What's the percentage right now of mortgages active? Darren Bloomquist was on the show. He said there's about 50 million-ish active mortgages.
Yeah.
What percentage of those are below 6%?
All right, so there's about 53 million. Yeah, I'll have to work with you.
He said 53, but I round down, Rick.
It's okay. So we're on the same page.
Yeah.
I've taught Darren well. Sorry, Darren, if you're watching this. There's about 53 million active mortgages.
Which, by the way, I have to say, he hated that I was rounded down to 50. He was like, no, 53. Make it easy on me, Darren. So Darren, it was my fault, not yours.
So here's how it breaks out. 93% of those mortgages have a mortgage rate of 6% or lower. 70% have a mortgage rate of 4% or lower.
So meaning the first number's a 4?
First number's a 4.
Or the entire number is 400.
It's either 400 or less than that. Yeah. So it's not 4.1, it's 40 or lower. 70%. So those people aren't moving. And I could give you a number, but I'd be making it up. I've read some data on the ones that are below 3, and it's a significant chunk. Equity is at an all-time high. So not technically at an all-time high.
That was last year.
Well, it's funny. We lost in the last 6 months. We lost $287 billion in homeowner equity. So now we're down to $27 trillion of homeowner equity.
Is that it?
Yeah, We're down from about 28 trillion last year to 27 trillion this year. And there are still, believe it or not, a handful of homeowners out there, probably 2-3%, who are underwater on their loans. These are markets in Mississippi and Louisiana that just never really recovered, and were probably speculative buying back in the day. What's really important for people to understand, especially if they're looking for those foreclosure deals, and I'm sure you and Darren talked about this in detail, 90%, 92% of homeowners in foreclosure have positive equity. Here's the scarier one. If you're an investor, 88% of borrowers in foreclosure have more than 20% equity. So we're not talking about somebody who has 1% equity and just sneaking by. 88% have at least 20% equity.
Wow.
So if you're thinking about those people, and I'm sure Darren shared this number with you, but if you look at all distressed property sales, and we define distressed property sales pretty much the same way. It's you got an initial foreclosure notice, it's a property scheduled to sell at a foreclosure auction, or it's a bank-owned property, an REO that's being sold. So that's your universe of distressed properties. 63% of distressed property sales are in the initial stage of foreclosure before the auction. So these homeowners with equity are leveraging that equity. They're selling the property rather than losing everything at a foreclosure sale. And there's almost nothing going back to the banks because the properties that do make it to auction are selling through at record rates and 60-70% sell-through rates at these Super Tuesday events. And there's nothing left to go back to the banks. So if your strategy in the last cycle was, I'm going to buy all bank-owned properties, that's exactly the wrong strategy for this cycle.
Exactly the wrong strategy.
You need to be going way upstream. And you can think about the kind of deal you can work at. You go to an existing homeowner who's in financial distress. You're a rental property investor. You can have them tap into their equity so you can buy the property below full market value. They can walk away with most of their equity. You now have a property you can rent. And by the way, you probably have a tenant you can rent to who's already living there, who might not have been able to make up what the arrears they owed the bank, but can certainly pay market rent or generally pay market rent. And typically, if they're living there, they've taken decent care of the property. So you're not walking into a place where the piping has been ripped out of the walls, like you often did with a bank-owned home. So there's just, again, it's a different mentality, different mindset because the market dynamics are very different this time than they were last time. And you know this being a Marine. I didn't say former, I said Marine. A lot of generals get in trouble by fighting the last war. And I don't want your investors fighting the last real estate war.
Can we talk a little bit about multifamily now? I kind of cut you off earlier. I'm starting to see rent concessions. I'm starting to see 3 months free rent. I'm looking at the big hedge fund guy, Barry. Oh my gosh,
Barry Sterling.
Yes,
yeah.
Did an interview recently, and he said, "What you don't understand is the difference between a 2% cap rate and a 4% cap rate is a little more than 35% of the value of the property."
Yeah.
And he was like, "We've seen cap rates go from 3 to 6." He goes, and he was talking about the coming commercial, and multifamily is definitely included in that. I guess I'm looking for something negative to talk about.
Well, we can talk about commercial, but
how do you feel about the coming? Because Barry said something like $5 trillion worth of debt I don't remember the exact number, is up for reset in the next 2 or 3 years. Cap rates have moved aggressively. Office rents are way out of whack now with all the work from home and the relocation and all that.
Yeah.
Is that an opportunity coming?
Yeah. So the commercial market is an opportunity. Different kind of investment strategies, obviously. Typically a little bit more expensive investments, different kind of financing tools. So it's something you don't want to get into without educating yourself and doing your homework. I don't expect the multifamily market to suffer much. The kind of things you're talking about, I would refer to, and this is a very technical term, as normal.
Well, because they're trying to hit pro forma rent.
Yeah, they're trying to hit pro forma rent, and the worst sickness a landlord can get, the worst ailment, is vacancy.
Right.
If you have tenants that are paying you a little bit below current market rate, but you don't have to replace them, and they're making their payments every month on time, you're okay. And you can raise things gradually. Again, I think in some markets those price increases last year overshot the mark, and we're seeing them pull back. But if you look at numbers nationally on the multifamily side, you're somewhere between 1% and 3% annual growth in rents. So I wouldn't read too much into an individual building or a handful of buildings starting to make these deals, because if you go back before the pandemic, they were doing the same thing. You're competing with
pre-leasing,
all sorts of stuff. On the commercial side, though, I have seen some churn in foreclosure data. So if you look at commercial foreclosures, they're probably running 20-25% higher than they were prior to the pandemic. But keep in mind, in absolute numbers, it's a tiny number of properties in foreclosure. So instead of 400 foreclosures a month, there's 500. And you compare that to 20,000 foreclosure starts on the residential side per month, and it's a rounding error. But I would be looking at the hotel sector. We were talking about hospitality earlier. I can tell you from my days at auction.com that a surprising number of hotel owners in the limited service space, so Marriott, Fairfield Inn, and Hilton Garden Inn, and those kind of,
which a lot of times one person owns it and it's just operate. Okay.
Yeah, and that's exactly what I was going to say. You'd be surprised how many times those kinds of hotels are owned by one person, individual investor. Maybe bought them at an auction, but they don't have the financial wherewithal to go through 2, 3, 4 years of low occupancy rates. And they'd rather sell it at a little bit of a loss than have it foreclosed on and lose a whole bunch. So those are opportunities. There's some big hotels that have been foreclosed on. The Roosevelt Hotel in New York, kind of an iconic old hotel. Marriott Midtown East in Manhattan. Those were 2 hotels that were foreclosed on last year. Multi-million-dollar hotels. There was a company, I can't think of the name of the company, but I kind of got a kick out of this in a weird way. They held a press conference to announce they were walking away from a $900 million mortgage on 2 hotels in San Francisco, the Park 55 and the Hilton San Francisco. Again, 2 very iconic, very large hotels. But they did the math, and they came to the conclusion that from their limited partner standpoint, their investor standpoint, the hotels had lost so much value that it wasn't in their financial interest to keep paying the mortgage. And so the cities are hurting. So those big hotels, small hotels, and the office space is vulnerable. I'm not sure what Barry Sternlicht was quoting, but in the commercial mortgage-backed securities world, and a lot of these loans have been securitized, there's about $1.3 trillion of those MBS loans coming due for renewal in the next 3 years. Hundreds of billions of dollars of those are either offices or multifamily. There's one big security coming due on an industrial loan that kind of skews the numbers a little bit. I don't expect that's going to be a problem because the industrial market's very strong right now. But the office space, I was talking to the economist at the MBA, Mortgage Bankers Association, who covers the commercial space, and he said you can't paint the office market with the same brush. So if you're looking at central business districts in big cities, they're in trouble. San Francisco has a vacancy rate of 45% in downtown. Los Angeles, 35%. New York has a high vacancy rate. And people keep talking about repurposing these buildings. Let's take an office building and turn it into apartments. Great idea. Where are you going to park? Great idea. Who has the middle apartment in the building that doesn't have any windows?
Right.
Are you even allowed to have an apartment without any windows? What's the zoning requirement? You have 2 bathrooms on the floor right now. You're going to need bathrooms in every living quarter. So it's not nearly as easy as people make it seem. So the big cities are there going to be some opportunities there. Suburban markets, secondary and tertiary markets aren't suffering as much. But there will be some of this stuff coming due, and the banks will be anxious to move it because there's a lot of community banks, regional banks, who have a disproportionate amount of this paper, a disproportionate number of these mortgages. And if these mortgages start to fail, it could take the banks with them. So they'll be looking for an out that minimizes their losses, and you just have to keep your eyes open. We were talking before we went on live. There are services like LoopNet, where you'll see a lot of properties listed. CoStar owns that. They own 10X, an auction platform that used to be part of auction.com when I worked there. And they exclusively do commercial sales on that platform. And a lot of those properties are distressed assets. So if you're looking for places to go find those kind of assets, 10X is a great place. They have a competitor called Crexi, Crexi, that also does a lot of distressed sales online. So there are places investors can go and they can find low dollar commercial properties available for sale that can be bought at a discount and rehabbed and repurposed. And look for your local real estate broker who's a commercial broker, and they'll often have off market properties that they can help you get in front of.
You were talking about banks.
Yes.
And I can't remember where I read it, but it was a prediction of somewhere around another 100 or 200 banks that could fail over the next couple of years. Have you heard anything like that?
It's actually worse than that.
You think it's worse?
Yeah. The chief economist from CBRE, which is one of the biggest commercial brokerages in the world, actually, he and his team of analysts took a look at all 4,700 U.S. banks. And their conclusion was that, I'm going to round this one because I forget the exact number, but it was about 300 banks, that were in danger of failing because of their commercial real estate exposure. And it's not quite as bad as what you read in the media about the exposure. It's not like they have 80% of all commercial loans and the commercial market's all going to go topsy-turvy. But for CBRE to come out and say of the 4,700 banks, as many as 300 could be at risk of failing because of commercial downturn, tells you it is serious, and it's going to be on a market-to-market basis. But if you're in a local market, it's not going to be Bank of America. It's not going to be Wells Fargo. It's going to be
Chase is fine.
These are the people that are going to buy the assets of those banks when they go under.
The ones they won't.
Yeah. But it's going to be your community bank. It's likely to be a local credit union. It's going to be a regional bank that's not a huge regional bank. And the problem a lot of these banks have is as soon as the rumor mill starts, there's a run on the banks. And a run on the bank is, you pull out your cell phone now, and that's how you transfer your funds. This is not It's a Wonderful Life where Mr. Potter can lock you out of the bank.
And by the way, I don't even need to log into your bank. I log into my bank and initiate.
Oh, yeah.
I log into my Chase app and I'm like, withdrawal, transfer, and I'm going to ACH it out of your bank, the other bank. Yeah, I'm talking to them.
My banks are all connected online on my accounts.
Yeah.
So if I want to transfer I've been banking with Santander for years since I was on the East Coast, but I want to move from there to Wells Fargo or something else, it's a click and a off we go. So
they wake up every morning to this report like, they all left.
And that's what happened with Silicon Valley Bank. That's what happened with Signature. And then you took a look at their books, and besides the fact that they had, paper that they had to sell at a loss because they invested in bonds at exactly the wrong time and the wrong rates, they are sitting on a lot of commercial paper. And if it's commercial office space, it could be very vulnerable. I don't think we've seen the end of the fallout from COVID in the office market. I do know more and more companies are either encouraging or requiring their workers. Even Zoom, ironically enough. But one of
the best press releases I've read all year.
Yeah, you can't experience what you need to on online video and go, wait, what do you do? Anyway,
self-storage.
Yes. Again, one of the offshoots of people not moving is they run out of space at some point.
Right.
Or if your boomer does eventually move out and downsize, they need somewhere to put all their stuff. My wife and I have been in the same house now for 25 years with our kids. I can tell you that when the time comes, she's not going to want to unload everything because she's going to want the kids to have some of their, memories. But they're probably going to be in apartments when they start, and they're not going to have any room for this stuff. So self-storage, I think lots of opportunities in a lot of markets across the country. But it's like anything else, Tim. Do your homework. Educate yourself on what's going on in the market. The two things I tell investors to look for all the time, every time. Look for population growth and look for job growth. Those two conditions in the market, you're probably going to have a pretty good real estate market. And the opposite is true. And by the way, population growth should be adult population, not overall population, because I have also done extensive research to learn that most babies don't buy houses. So just because there are more kids doesn't necessarily mean you're going to have that demand hitting right away.
Babies don't need jobs.
No.
All right, we're going to take a quick break, come back, and then come up with more funny sayings. Stick around. We'll be right back.
REI Inc. is a monthly business publication for real estate investors, covering all types of real estate investments and strategies. It is the most comprehensive real estate investment publication on the market. All of the articles are written by the top leaders in the industry, so investors are assured of always getting the best information possible. Each month, REI Inc. also profiles the top companies in the industry and provides insights and data into key regional markets. Along with their sister platforms, the REI Referral Network and Highest Invest, real estate investors have exclusive access to off-market investment opportunities and national acquisition and disposition initiatives. To learn more, visit www.rei-inc.com, where you can also access the REI Referral Network. Also, be sure and visit www.highest-and-best.com to view the latest exclusive off-market assets with near immediate acceptance decisions and closing strategies. You can also email marketing@rei-referralnetwork.com to request more information.
Welcome back to Uncontested Investing. Tim Harridge here with the great, was it King of Data? Is that the moniker we gave him earlier, Emilio? All right, King of Data, Rick Sharga. Rick, it's time for the Money Minute, my favorite part of the show. Up to 60 seconds. There's an entrepreneur or an investor out there. They're going to hear this 60 seconds of advice, and it's the only advice or information they get all month. So it's got to be the best thing that you have compressed into 60 seconds. You ready?
I'm ready.
Go.
Patience is a virtue, and education is a necessity. You need to be really good at math in today's market. Don't jump at the first opportunity that you see, because there will be other opportunities, but make sure whatever opportunity you do pursue is an opportunity that pencils out for you. Much more difficult to be a fix and flip investor in today's market because of prices and financing costs. There will be lots of rental opportunities, just demographically speaking, over the next couple of years. So think maybe short-term rental, long-term fix and flip, and look for those two things that Tim and I were talking about earlier in any market you're going to invest in. Ignore the national numbers. They don't matter in your local market. Look for markets where population is growing. Look for markets where wages are growing. Look for markets where jobs are growing. Those will universally, almost always, be good real estate markets.
Okay, so you didn't mention anything about politics when selecting markets, so I'll just leave that one alone too.
I think you should. Although 400 California net loss last year, 400,000 people. And I was talking to somebody and they said, "Oh yeah, but there's 40 million people there." I said, "No, you don't understand. It's net loss. Net loss. I mean, it's 400,000 more left than came in, and the ones that are leaving." And this probably is interesting for
Now they live right out there.
Well, they're coming to Dallas. They're going to Idaho. They're still Coeur d'Alene is a really nice place from what they tell me. They're going to Arizona. They're going to Florida. A lot to the southeast, by the way. But it's California can't afford to just kind of say, "Oh, tut. These are all retirees leaving." These are not all retirees leaving. They are retirees who, by the way, still spend a lot of money. And they're also young professionals. I told you I have 2 young adult children living at home. My daughter graduates from college in May. My son just got engaged. He's a teacher. His fiance is a lawyer. They are talking to me about what state they should be looking at to move to so they can own a house. That just ain't happening in California. And a lot of that is, it's not politics exactly, but it's regulatory rules that have been put in place by politicians, both at the state and local level, that make it just about impossible to have affordable housing in the state.
Well, I mean, right now, it's the workers are on strike for the big 3 automakers, and there was an article in the Journal today talking about all the other companies, most of the manufacturing is being done in the South where there's not labor unions.
Right.
And, and is that the future? And ultimately, it is what it is, because if I can't sell you the truck for $200,000 and I got to sell it to you for $100,000, I got to make money, right? So I got to make it for less. And so it's going to be interesting how that played out. Also, in your Money Minute, you talked about patience, and be okay to say no. Greg Herleen, the founder of Horizon Trust Company, was on the show right before Labor Day, and he talked about that. He said, you can change your mind when you say no. You can't change your mind once you say yes, right? Like, and he was saying that just say no to a deal. If it comes back around or the situations change and then you decide to do it later because you thought about it, you did more research, like that's a lot better than saying yes and wishing you hadn't.
Yeah, look, this is a tough market. Let's not sugarcoat it too much. There's opportunities in every market and across the country, but it's a tough market. And I know seasoned fix and flip investors who have gone under on deals. They've lost a lot of money on deals over the last couple of years because they bought it exactly the wrong time, had completely overestimated what the ultimate value of this property was going to be, and it's sunk X number of repair dollars into it before the market turned. Now I don't think there's as much of that. So some reports that I've seen recently show that gross margins, at least, what you sell the property for compared to what you bought it for, have now gone up 2 consecutive quarters. So they're coming off the bottom, but they're still not as rich in most markets as they were a few years ago. And the other thing is follow the money. We didn't talk about that in the money minute, but if you look at what the bigger investors are doing, there's a reason they have all that money. And they tend to be looking at markets in the Midwest, South and Southeast, where you can buy a property for an affordable amount of money, fix it up, and then rent it out and make money every month on your rent. You go to California, where the median price of a home for sale or home sale today is $850,000. You have a limited number of renters who are going to be able to pay what you need to charge in order to make money on that.
Right.
So, know your market, know if it's a fix and flip market or if it's a buy and hold market, know what the going rates are. And just, I can't say it enough. You go over that deal with a microscope. Make sure you know exactly what you're getting into. If you don't know what you're doing, talk to Tim, and he'll tell you. But that's great advice. Is you can say yes after you've said no, but you can't say no after you said yes. And if you got into the wrong deal, it's going to cost you.
So I've got about 5 to 10 minutes left. The Federal Reserve today, as we're recording this conversation, decided to hold rates steady.
Mm-hmm.
They said that the rates would be above 5. The federal funds rate would be at or above 5 in their estimation for the duration of 2024. Mm-hmm. They expect unemployment to rise a lot slower than previously. They expect the economy to do better for longer mm-hmm. than previously estimated. And the theme is there'll probably be another rate hike this year, according to the release, and rates will be higher for longer.
Yep.
How, in the most simplistic way possible, how will that impact investors in 2 buckets? Let's just say the short term for the next 12 months and then the long term, beyond 12 months.
Yeah, that's a really good question.
I thought you were about to tell me to let me know when you found out the answer or something.
No.
I thought one of your little snips was coming.
I'm tempted to, but yeah. So first of all, there's posturing and there's action, and I think they had to combine a fairly hawkish, aggressive posture today with the fact that they weren't going to raise rates at this meeting.
So we're not taking action. So act like we're still serious.
Yes, and reinforce the fact that we are absolutely committed to getting inflation down to 2%, whatever it takes, and there will be some pain and so forth and so on. But they hedged a little bit today, and you characterized it correctly. Unemployment may be more gradual than we thought, and in fact, they're not saying it out loud, but they may be thinking maybe it won't get as high as we thought. They're talking about the GDP being stronger now. And that's all true. The consumer is doing very well, but there are red flags they didn't talk about today in that consumer behavior. So keep in mind, the gross domestic product of the U.S. is about 2/3 based on consumer spending. So there's government spending, there's business spending, there's some other odds and ends, but 2/3 is consumer spending. Credit card use last quarter exceeded $1 trillion for the first time in history. Savings rates are down below historically normal levels.
So not savings account dollars yet, but savings rates.
How much? Yeah, what?
So if I make a buck, how much of that do I put back?
Exactly right. They went to all-time highs during the pandemic when the government was sending out stimulus checks. They are now below historically normal levels. From my perspective, I look at those consumers and I say, are they using credit cards and dipping into savings to make ends meet? Because the inflation numbers we're seeing are going in the right direction gradually, not straight down. They bumped up a little bit in the last couple of months. But I have what I call my Costco price index. And I buy salmon at Costco, and a year ago it was $9.99 a pound. Today it's $12.99 a pound. That's a 30% increase in my Costco price index.
Yeah.
So we see inflation running at 3.5%, 4% right now, depending on which numbers you're looking at. But I think for those families that spend a higher percentage of their monthly income on food, on energy, on gas, because gas prices are going up too, they're stretched, and they're stretched pretty good. And so the overall rate of inflation may be coming down, but those households, particularly median wage households and below, I'm worried are going to shortly be in a position where they're trying to figure out what they're going to pay for this month. We've seen auto loan delinquencies spike up. Very different behavior, again, from the last cycle we went through when people were not paying their mortgages, but they were making their car payments. And the joke at the time was, you can sleep in your car, but you can't drive your house to work. And most of those borrowers were underwater on their loans, on their mortgage loans,
And they didn't have a 3% interest rate.
right? And today they have that low interest rate. They have a ton of equity. They don't want to lose the house.
Right.
But you want to take the car? Great, I'll take a bus to work. So it's a very, very different market. If you're an investor in this market, it means that your borrowing costs, your finance costs, are also going to stay higher longer. So while a lot of the economists I talked to and I as well had been thinking that we might be back down in the 4s by the end of next year in terms of mortgage rates, that's probably not going to happen until 2025. So your finance costs are going to be higher. It also means, since mortgage rates will remain higher, inventory is going to be stubborn and not come back to market. So you're going to have less to choose from. As the institutional guys open their wallets again, you'll start to find more competition from them as well. And they'll do that as market conditions start to change a little bit. I would not, by the way, take what Chairman Powell said about no rate decreases next year at face value. I would not be stunned if we saw Fed funds rates come down next year. Not dramatically, because they are adamant about getting overall inflation under control. But I think there's, like I said, there's posturing and there's action. And I would not be at all surprised if the economy does start to slow down, if you don't see them start to reduce the Fed funds rate to kind of stimulate things a little bit next year.
I'm a bear.
Yeah.
I'm not a bull. I look at the way the money has went into the economy, in the people's bank account, and has left and is leaving. Greg Hurley talked about the amazing amount of redemptions he's seen lately, like people just cashing in their retirement accounts.
Yeah.
401k withdrawals are on the rise. And I think I remember 2008 when people started losing their jobs at like the Target distribution center. There's one specific tenant in mind. And I think that's a snowball that once it starts, I think the Fed is overestimating their ability to pull back and stimulate the economy, because it's got me personally worried about the average consumer. I think the people with the skilled labor, college graduates and good jobs that actually do go to the office, I think they're fine. But the consumer and the less qualified jobs that are easy to replace by a robot, I think they're going to be in a world of hurt.
I'm somewhere between bearish and bullish. I actually, because I'm a bit more skeptical, I would actually be surprised if the Fed was able to avoid a recession this time around. If you look at the last 11 times they raised the Fed funds rate, going all the way back to World War II, in order to get inflation under control, 8 of those times, they steered us into a recession. The 3 times they didn't were 3 times where they were proactive and they saw inflation start to look a little dicey and they acted immediately. And so it was proactive early on before inflation got out of control. They've already admitted, so I'm not throwing them under the bus here. They've already admitted they missed that window this time. Yeah. They underestimated how high inflation was going to get.
It was transitory.
It was transitory. It wasn't going to stick around. I mean, they missed on just about every metric you could imagine.
But they're still in charge.
but they are still, and they're going to be in charge for a while. And because of that, we've had these unprecedented number of back-to-back rate hikes, high rate hikes, and it has thrown the financial markets into turmoil. You almost can't recover from something like that without a recession. Yeah. And the other thing that I look at is, and this inside baseball for everybody, but it's a yield curve inversion. So, and that's based on yields on long-term bonds versus short-term bonds. And in a normal market, a long-term bond will have a higher yield than a short-term bond because there's more risk, it's a longer investment, so forth and so on. Every now and then, the bond market senses a disturbance in the force, and things shift. And your 2-year Treasury bond will have a higher yield than your 10-year Treasury bond. And if you're in one of those cycles, it doesn't cause a recession, but it means the bond market has decided that there's enough churn, economically speaking, that bad things are about to happen. The last 8 times we've had a yield curve inversion, it's been followed by a recession. I just don't see any reason why this 9th time, where we've had a pretty significant inversion, a deep one, and a fairly long one, it won't be an accurate predictor this time. I don't know why that would be the case.
Well, I mean, right now, Jennifer and I have a lot of money in 30-day CDs. Yeah. I mean, 5.5% money market account. It's higher than inflation. Yeah. I'm not paying 8% debt. I mean, it is what it is. So we're out of time. If someone wants to get in touch with you, they can follow you on X, not Twitter.
It's Twitter.
I know Twitter.
It's Twitter. I don't care what they say.
As long as you can still type in Twitter, it's Twitter, right?
Yeah, my Twitter handle is my name. It's Rick Sharga, and easy to find. If you want to connect on LinkedIn, tell me that you saw me on Tim's show, because I get a lot of really interesting.
But now they can just click follow. They don't have to.
That's true. Yeah, but feel free to connect. I don't mind connecting if you're in the real estate industry. And again, my website is cjpatrick.com, and yes, I have to update the blog.
Well, man, I know you were at the 5-Star Conference. I really appreciate you making your way up here. It's always a pleasure for me.
Always a pleasure for me.
This is the longest one I've done in 2 years. Oh. So there you go.
All right.
But thank you for being here, man. I really appreciate it. We're out of time. Watch this one twice. I promise you will learn something the second time that you missed the first. But until then, remember, your network is your net worth, and today you've been growing both. We'll see you next week.
Thank you for listening to Uncontested Investing. Questions about today's episode or the podcast? Email podcast@rcncapital.com and make sure to follow REI Inc. magazine on LinkedIn and Facebook, and RCN Capital on Instagram, LinkedIn, and Facebook. See you all next time.